Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Erik Lundh, Senior Global Economist for the Conference Board and guest host of today's episode. Joining me today is Stephanie Guichard, Senior Economist of Global Indicators at the Conference Board. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index as well as our outlook for the global economy. Welcome, Stephanie.
Hi, I'm happy to be there.
Well, Stephanie, let's launch straight into it. What is the biggest takeaway from the February U.S. Consumer Confidence Survey?
Okay, so consumer confidence registered its largest monthly decline in 3.5 years. The index is now at 90 versus 105.3, so a decline of 7 points in the month. And the decline was broad-based. So by age group, income group, we saw a decline in confidence for kind of everyone.
So before we get into the details of the Consumer Confidence Survey, TCB released its quarterly CEO confidence measure last week. Is the mood of CEOs different from the mood of consumers?
Totally. So a survey that was released on Thursday last week showed a strong improvement in CEO confidence. This is a quarterly survey, so we see a strong improvement since October. But so it's going in very different direction from the consumer confidence. And, we think that it's because we are not looking at the same things. I mean, CEO have been cheered by announcements or business-friendly policies by the incoming administration. And, they are expecting fewer regulations, potentially lower taxes. So they are quite optimistic right now. And the big uncertainty that was the election is behind us. So this is supporting the mood of CEO. On the other hand, consumers are looking at things that are affecting their day-to-day life. They saw some slowing on the labor market. They saw higher inflation. So we think this is what is getting them worried. And this is why, they are going in a very different direction than CEOs.
So can you tell us a little bit more about what happened this month on the consumer side?
So this month on the consumer side, we saw a decline of most components except consumers' assessment of present business condition that increased a little bit. And if you want to look at the sharpest decline, I mean, they were already on the expectation side and mostly on future labor market conditions and future business conditions.
So let's drill down into these sort of two components, right? We had the present situation and we have future expectation. What drove changes for present situation this month?
So for the present situation, we had a slight improvement in the assessment of current business conditions. However, this was more than compensated by a decline in consumers' assessment about current labor market conditions. So we're asking consumers, are jobs plentiful or hard to get? And we saw some increase in the number of consumers saying, well, jobs are hard to get. And the decline in the share saying that, yeah, it's easy to find a job if I start looking for one.
And you already touched on it, but maybe we can go over a little bit more deeply. On the future expectations side, what were the primary drivers there?
So again, the labor market. So we had some optimism about the labor market during the fall, and this has faded over time. And now consumers were not only pessimistic, but quite pessimistic about the future of the labor market. They turn also pessimistic about future business conditions. And if the third component is future income, so they are still optimistic about future income, but a bit less than in the previous month. And that's important that they are optimistic about future income, because it means that although they expect the labor market to deteriorate, they may not be worried about losing their jobs. Just like maybe more difficult to find a job if I want to switch or if I had to look for one. But so far, I'm expecting my income to be relatively good, so which means that I'm not expecting to lose my job. So this is the way we are reading this index, and so it's not very good, but could be worse.
So those are the principal sort of components of the headline index, but there's other questions that we ask that are also quite relevant and interesting. Can you tell us a little bit about consumer inflation expectations and what drove those data this month?
So consumer inflation expectation increased significantly in February. So from 5.2% for the 12 months inflation expectation to 6%. So it's a sharp increase, and we are at the level that we didn't see in 2024. What's driving that? I think it's a multiplicity of factors. So first, you have inflation has been sticky, and consumers saw some decline in inflation in 2024, but then they saw a pause, and then we have some slight increase here and there. So they are getting more concerned about the future of inflation. On top of that, you have all the discussions about tariffs and the fact that tariffs are going to make the cost of many imported goods more expensive. And then very recently, we had a sharp increase on the price of something that most American households are buying is the price of eggs. And this is really due to the consequence of the bird flu. There is a shortage of eggs, prices are increasing, but this is really affecting consumers. And when in our writing responses, we saw an increase in the references to the price of eggs affecting consumers' views of the economy. So we saw like a net increase in February. And this is kind of something we saw in, I don't know, 2022, 2023, where there was a similar increase in the price of eggs. So these are three factors overall that are affecting consumers' views of inflation going forward.
Well, I mean, we've certainly in my household noticed the egg prices and empty shelves too, for that matter, where eggs used to be. One of the other things that we watch, of course, are our retirement portfolios and the stock market. What are consumers' expectations for the stock market?
So earlier this year and at the end of last year, consumers were extremely, extremely bullish about the stock market.
No, no pun intended, of course, right, Stephanie?
But now they're a bit less optimistic about the stock market. However, it's still relatively high. So we still have almost half of consumers expecting the stock market to increase. So I think they're still relatively optimistic about stock prices, but a bit less than they were, in November, December.
So was there any good news in the survey this month?
So not really. So we always look for the upside in the survey. And honestly, this month, when we look at other indicators, I mean, the consumers' assessment of their current financial situation and the expectation for that financial situation. I mean, the good news is they are still relatively positive, but the bad news is they declined substantially from January, where they were at the highest point in the series. So that could be, I mean, that's the one that is still under positive territory and that it's still good, but we also saw a decline there. And if I look at the other components, I think the only one that is pointing to the upside in terms of spending plans, for instance, is spending plans for buying a home. So we saw some increase in consumers' intentions to buy a house, which could be linked also to the recent decline in mortgage rates.
Okay. One of the other parts of the survey that I really like are the write-in comments, because they're always sort of evolving and changing. What did we see? What was of interest in terms of the write-ins?
So in terms of the write-ins, inflation is still very high in the mind of consumers. But I think for the first time in 2 years, there is something else that is kind of at the same level as prices and inflation. It's the policies of the new administrations, the new president. So we saw an increase in references to the new president, the new administration. And before you ask me, I can tell you it's both ways. Very positive comments and also more negative comments. So it's really in both directions. The other thing that's interesting in the writings is we saw some increased references to tariffs. And that's new. We hadn't seen it that high since the previous administration, like 2018, 2019. So that's something notable also in the survey.
Well, it's certainly in the news a lot, isn't it? You already mentioned sort of the outlook in terms of home buying plans. What about, durable goods and services? Any mention in terms of outlooks for spending on those categories?
So we see a slight decline in buying plans for cars. We also see mixed, but mostly downward revised plans for appliances. And for electronics that we monitor also, I mean, things don't look very good. I mean, consumers' buying intentions have declined. There is a possibility for all these goods is that they bought appliances and electronics at the end of last year because they were expecting the tariffs. So they don't need to buy them now. So that's a factor that may be playing. The other factor that is likely playing is, if they think that it's going to be too expensive, they're not going to plan to renew their appliances this year. So you have the two things. Maybe they bought in advance, they don't need to buy, or maybe they think it's going to be too expensive, they are not planning to buy. In terms of services, the most important service to spend on for consumers is dining out. And then this is followed by a series of other services. But what we saw this month is some decline in travel plans and some increase in plans to spend on personal care or healthcare.
Okay. Okay. So, stepping back a little bit and thinking about what we're seeing, in all these data, what does the consumer confidence survey tell us about household spending this year?
So we need to take a step back, and if we look at 2024, I mean, consumer confidence was kind of within this range where it is right now. I mean, it's like slightly above the long-term average. We saw some ups and downs, but consumer confidence is still within this range where, last year they spent. I mean, we had healthy consumer spending last year. So we still in that range where consumer was spending and spending was healthy. So far, I mean, we're gonna take this into account seriously, the fact that it has declined by 7 points this month, but we will need to see a few other months to see the direction. And if the direction is still stable, a bit up, a bit down within that range, it's not a bad sign for the economy. Like, it means that, our forecast is, we don't need to revise our forecast. If it breaks free from that range and goes further down, then we can start to worry about consumer consumption.
So we have heard a lot about this range over the last 2 years, and it is true. The index has sort of oscillated, in a certain space. Would it take potentially for the index to break free of that range?
If you think about the downside, it will be certainly if the labor market starts to deteriorate. I mean, so far, CEOs are telling us they're going to keep on hiring, or in the worst case, they're going to keep their hiring. I mean, they workforce stable. So if that's the case, then all good. If we see some increase in layoffs, then it's going to start affecting consumer confidence further. It's going to validate the current pessimism about the labor market going forward, and it may turn into affecting deeper the income components of our index. So that would be one of the cases where this could, push the index further down outside the range. On the other side, we need to be balanced, and I think we saw sometimes last year some surprising increase in consumer confidence. So if the worries about the labor market do not materialize, then consumer could regain confidence. And they've done it last year in the fall at some point, after being pessimistic about the labor market, they realized that labor market was doing well. Then they became optimistic about the future. And it may happen again this year. So it's really, I think, what's going to happen on the labor market in the next few months that is going to affect consumer confidence. Inflation is not directly going into our index, but we still think it's affecting the way consumers view the economy, especially business conditions. So we may still, if we see some increase in inflation beyond the price of eggs, this could also affect consumer confidence negatively. If we see some slowing in inflation, and especially if the price of eggs go back to where they were last year, potentially it could drive consumer confidence up.
Thank you, Stephanie. That was a really great summary of these data. We're going to take a short break and be right back with more of our conversation.
Welcome back to C-Suite Perspective. I'm Stephanie Guichard, Senior Economist at the Conference Board, and I'm joined with Erik Lundh, senior global economist at the conference board, and he asked me earlier lots of questions about consumer confidence. So now we're gonna turn the table, and I'm going to ask him lots of questions about the global economic outlook.
Great. Let's do it.
So let's start with the US economy. So, especially after discussing our consumer confidence, our CEO confidence earlier today, is the US economy still on track for another year of solid growth?
So for the U.S. economy, we're forecasting growth of about 2.3% this year versus about 2.8% in 2020. So this, while this is a slower growth rate, it's still a pretty solid one. Trend U.S. growth is around 2%. So we're still expecting to see growth elevated relative to potential, but sort of the character of that growth has sort of evolved in our minds. We've made some changes to our forecast in terms of where that growth occurs. We think more of it will happen in the first half of the year, and we'll see a little bit more of a slowdown in the second half of the year. In terms of strength among the U.S. Consumer, we're still expecting to see robust spending like what we saw in late 2024, again, more so in the first half of this year. But again, we're expecting, really in most ways that the U.S. Consumer is going to moderate its spending later in 2025, and it'll help to cool the economy down a little bit.
Okay, great. So why don't we see sharper decline in interest rates this year?
So that has a lot to do with what we've been seeing in inflation, which you talked about during the first half of the program. Following a lot of progress in inflation, earlier in 24 and beforehand, the inflation rates have gotten sticky, and we haven't seen additional sort of slowdowns in sort of general price levels. So the Fed has targeted, of course, 2% inflation. That's where it's trying to get to. But it's not seeing the tight monetary policy that it's already implemented really, continue to have the impact that it had. So the Fed started to reduce interest little by little towards the end of 2024, but it's really paused them. It's waiting for that sort of more aggressive monetary policy to continue to do its work. That hasn't been happening lately. And so as a function of that, the Fed has sort of held off and kept rates steady. We think it's going to continue to do so. We're not expecting to see interest rates decline in the first 2 quarters of this year, but we do think that later in the year, probably in Q3, we'll see maybe a 25 basis point cut sometime in around July, and then 2 more cuts potentially later in the year as well. So we're on hold right now as inflation continues sort of to hopefully find its footing and moderate a bit. And then interest rates hopefully will come down towards the end of 2025.
So just a quick question. Do you think, in our consumer survey, we saw this increase in consumer inflation expectations. So is it affecting your forecast and your expectations for the Fed in 2025?
I think, there's a couple of things going on the inflation front lately. You mentioned egg prices, which is sort of an immediate thing that consumers perceive, and it may be behind some of the uptick in the consumer confidence survey. But we've also been hearing a lot about tariffs as well, right? Tariffs on Mexico and Canada and China. A lot of that hasn't really manifested itself into actual policy action yet, but it does have the potential to do so. So, in the event that we do see, these 25% tariffs put onto some of our closest and largest trading partners, that is going to have an impact on inflation. It's going to drive up the cost of those imported goods. If again, that occurs, it's going to change the Fed's calculus in terms of what it needs to do. We could see rates stay static, for even longer than what we currently forecast. Potentially, we could even see a reversal in terms of the policy stance and see interest rates start to go up again. Now, that's not our base case, expectation at this point, because again, we haven't seen policy action. We've seen sort of policy discussion and some threats, but it's something that we're watching pretty closely, and it really could sort of change the narrative of, especially I think, the second half of 2025 in terms of inflation, in terms of interest rates, and in terms of growth.
Yeah, so I mean, you mentioned you've done some work on the impact of tariff on the US economy and also, I guess, on the global economy. So can you tell us a bit more about the results of this scenario analysis?
Sure. So, we there's a there is a lot of uncertainty on this front right now, but there are a couple of sort of scenarios that have been pitched by the administration, and so we've tried to do some work to try to model what those implications might look at. The first scenario that we've been looking at relates to Mexico, Canada, and China. There have been proposed tariffs of 25%, 25%, and 10% respectively. The China tariffs have been implemented, but the Mexico and the Canada tariffs have not. Currently, they're scheduled to go into effect. And according to the sort of modeling that we've done surrounding these tariffs, if they are implemented, and implemented not just for a month, but for a full year, they could have some pretty significant implications for the U.S. economy. According to the work that we've done, we're expecting that we could see somewhere along the lines of a 0.9 percentage point cut in our forecasted growth rate. So a headwind of almost a full percentage point, which would bring the growth rate for the year for the U.S. From our current 2.3% forecast down to something along the lines of 1.3 or 1.4%. Another scenario that we've been looking at, which it maybe isn't quite as immediate, addresses a blanket 60% tariff on all Chinese imports. This was first proposed by the administration earlier this year. It hasn't been talked about as much, of course, as the Mexico, Canada, China numbers that I just outlined. This is a separate sort of set of tariffs for China. But if it is implemented, again, for a full year, the implications could shave an additional 1 percentage points off of U.S. growth. So again, pulling that growth rate down, from about 2.3 down to 1.3, 1.2 or so. And then a final sort of scenario that we've been looking at involves a sort of blanket 10% tariff on all imports coming into the U.S., regardless of the origin. If that were to occur, again, for a full year, we're looking about a 0.7 percentage point headwind to growth. So all three of these scenarios, do throw cold water on the U.S. economy. They do significantly slow down some of the growth that we're expecting to see, but they don't necessarily, trigger a recession in the U.S., at least not individually. There is an important caveat, I think, and that is that these sort of calculations and models that we've run, they don't include reciprocal tariffs. So, if we put 25% tariffs on Canada, the government there has announced that, they would respond by putting tariffs on U.S. exports to Canada. And so I think that there is, potentially even more downside risk that we don't have fully integrated into these scenarios that would also, make the pain for the U.S. even more acute.
Okay, thank you. So I guess the big question is, for now, my understanding is these are risks around the forecast. So at which point would you considering moving them from the risk scenario to the baseline?
So, as I mentioned, we hear a lot of things being talked about, but we don't hear or see, I guess I should say, as much of being implemented. So, we're cautious about sort of folding these scenarios into our base case forecast for the U.S. But if we really start to see, that sort of script flip, and that the tariffs actually start to, be collected at the borders, more, for more than a week or more than, a negotiating sort of period, that would be, I think for us, an indication that it's really time to make some serious downgrades to our forecast for the U.S. economy.
Okay, so let's move a bit away from the US economy to the global economy. So if you can tell us what's our current outlook for the global economy?
So it hasn't changed too much in recent months. Our forecast for 2025 is 3% growth, sort of at the top global level, versus about 3.1% in 2024. So just a touch softer. And at this point, we're really expecting to see the global economy stay stable. But again, it's predicated on, you know, no major disruptions in terms of trade flows.
Okay, so maybe you can tell us a bit more about you describe these scenarios for the US in the case there are tariffs. How would it affect the rest of the world if the US starts implementing these tariffs?
So we've taken a look, really specifically because it's sort of at the forefront at Canada and Mexico. So economic activity in both Canada and Mexico disappointed really in late 2024. GDP growth in Canada slowed to about 1% in Q3 from about 2% at the start of the year. And GDP growth in Mexico actually deteriorated to about minus 0.6% in the last quarter of 2024. At present, for 2025, we forecast that Canadian GDP growth will expand at about 1.5%, and that Mexican GDP will expand at about 1.2%. So both sort of on the lower end of the spectrum. They're not, charging forward in the same way that the U.S. economy is. Given that modeling work I just talked about, we also looked at what the implications would be of these tariffs on those two economies. And this is essentially what we found. So the implementation of tariffs could potentially cut Canadian GDP growth to just about 0.6% in 2025. Which is about a 0.percentage point hit relative to our baseline forecast. And Mexican GDP growth could actually fall all the way to about 0%, again, versus that 1.2% expectation. So we're closely watching the trade negotiations in North America. We're waiting to see if these things actually take effect or if negotiated settlements come out of them. But again, if the rubber hits the road, so to speak, it's not just going to be the U.S. economy that gets downgraded. We'll be downgrading Canada and Mexico as well.
Is there anything else about other countries that you think we should mention here? I mean, my understanding is that compared with last month, we didn't change the forecast too much, but just if there is anything else you think we should cover.
I mean, we're still watching sort of end of year national accounts data come in for various countries around the world. So that's really important in terms of sort of shaping the trajectory of growth for most economies as they move into 2025. We're watching Europe closely. They had a difficult 2024. Germany fell into technical recession, and really, the economic momentum in Europe wasn't all that great from what we can tell so far in Q4 of last year. But we're watching inflation on the continent. We think monetary policy will ease a little bit more at the ECB this year, and so that should help to stabilize growth in Europe. And then really, for other major economies, it's sort of a wait and see. I think we'll have more changes to talk about during the March episode when we have some additional data to sort of shape again, how things are starting off in 2025.
Great, thank you, Erik. So that was a great conversation. Thanks for being here with me today.
It's great to be here.
And thank you all for listening in to C-Suite Perspectives. I'm Stephanie Guichard, and this series has been brought to you by the Conference Board.